Imagine waking up one morning and discovering that two of the entire world's annual silver supply just changed hands in a single transaction. Not over weeks, not through the market, but in one forced delivery between two of the most powerful banks on the planet. This is not a simulation. This is not market speculation. This happened 48 hours ago while you were celebrating the new year. Deutsche Bank was forced to deliver 3 million ounces of physical silver to JP Morgan. That is 216 million worth of metal at current prices. And JP Morgan now controls 80 of all silver deliveries on the COMEX. The question is not what happened. We know what happened. The question is why. Why would Deutsche Bank surrender this much silver? Why would JP Morgan demand it? And what does this tell us about the state of the physical silver market heading into 2026? In this investigation, we are going to break down the mechanics of the transfer. We are going to connect it to the margin hikes, the China export ban, and the 50 price spread between Tokyo and New York. We are going to show you why this is not just a bank trade. This is a survival move. The paper market is breaking. The physical float is gone, and the banks are fighting over the scraps. This is the story of the 3 million ounce panic. Let's start with the raw data. On January 1st, 2026, Deutsche Bank made a delivery of 3 million ounces of silver to JP Morgan on the COMEX. This was not a voluntary sale. This was a forced delivery. How do we know? Because of the margin calls. On December 30th, the CME Group, the exchange that runs the COMEX, raised margin requirements on silver futures by 30. This was the second margin hike in 7 days. When you trade futures, you only need to put up a fraction of the total contract value. This is called margin. If silver is 70 and you want to control 5,000 ounces, you don't need 350,000. You only need about 20,000 in margin. But when the exchange raises the margin requirement to 26,000, you either deposit more cash or you liquidate your position. This is what happened to Deutsche Bank. They were holding a large short position in silver. When the margin went up, they could not or would not post more collateral. So they were forced to deliver the physical metal to close the trade. But here's where it gets interesting. They did not deliver to the market. They delivered to one entity, JP Morgan. This means JP Morgan was on the other side of the trade. JP Morgan was long, Deutsche was short, and JP Morgan just squeezed them. This is not normal market behavior. This is a bank war. Why would JP Morgan want 3 million ounces right now? Because they are preparing for a supply crisis. Let's go back to December 15th, 2025. That is the day China announced an export ban on silver starting January 1st, 2026. China is the third largest silver producer in the world. They mine about 100 million ounces per year, and they just cut off exports to the West. This means Western refiners, Western mints, and Western industrial buyers can no longer source silver from China. The available float in London and New York just shrunk by 20. When supply shrinks, those who control the remaining supply gain enormous pricing power. JP Morgan just secured 3 million ounces of that supply by forcing Deutsche to deliver. They are not buying this silver to flip it for a profit. They are buying it to survive. Because JP Morgan is the custodian for the largest silver ETF in the world, SLV. They are responsible for backing those shares with physical metal. If redemptions spike and they don't have the metal, they default. By forcing Deutsche to deliver, they replenish their ammunition. Now let's talk about the price spread. While this bank war was happening behind the scenes, something bizarre was happening on the price charts. On January 2nd, silver in Tokyo was trading at 130 per ounce. At the exact same moment, silver on the COMEX in New York was trading at 72. That is a 58 spread. That is an 80 premium. How is this possible? Because the physical market and the paper market are splitting. In New York, you are trading contracts. You are trading promises. The price is determined by algorithms and margin traders. But in Tokyo, you are trading metal, real bars, real delivery, and there is no metal available. So the price goes vertical. This is what we call market dislocation. The paper price says 72. The physical price says 130. Which one is real? The one where you can actually get the silver. And right now, if you are in Asia and you want silver, you are paying triple digits. This is why JP Morgan is hoarding. They know the paper market is a lie. They know the physical market is the truth. And when the rest of the world figures this out, the price in New York will have to catch up to the price in Tokyo. But if JP Morgan controls the supply, they control the pace of that repricing. They can manage the explosion. Let's talk about what this means for Deutsche Bank. Deutsche is one of the largest banks in Europe. They are a major player in precious metals trading. Why would they surrender 3 million ounces instead of posting more margin? Two theories. Theory 1. They are insolvent. They do not have the liquidity to meet the margin call. Banks are highly leveraged. If they have a large derivatives book and multiple positions are going against them, they might not have the cash to cover. Delivering the silver was the only way to close the position and avoid a default. This would be catastrophic because it signals that a major European bank is in financial distress. If Deutsche cannot meet a margin call in the silver market, what else can they not cover? Theory 2. They made a deal. Perhaps JP Morgan offered them a way out. Perhaps JP Morgan said, "Deliver the silver now at a fixed price, and we will not report your liquidity crisis." This would be a backroom settlement to prevent a public default. Either way, Deutsche lost. They lost the metal. They lost the position. And they lost face. JP Morgan won. But there is a third layer to this. JP Morgan is not just a trader. They are a custodian. They hold hundreds of millions of ounces for the SLV ETF. This creates a conflict of interest. When they trade against other banks, they have inside information. They know the inventory levels. They know the redemption flows. They know when a squeeze is coming because they can see the vaults draining in real time. This is like playing poker when you can see the other player's cards. The CFTC, the regulator, knows about this conflict. In 2020, JP Morgan was fined $920 million for spoofing the precious metals market. That case proved that they used fake orders to manipulate the price of silver for years. They admitted guilt. They paid the fine, but they kept their trading license. They kept their custodian role. Nothing changed. So when we see JP Morgan squeezing Deutsche Bank for 3 million ounces, we have to ask, is this a fair market transaction, or is this the same manipulation with a new skin? Are they using their information advantage to force other banks into liquidation? And is the regulator going to do anything about it? The answer is no, because JP Morgan is too big to jail. They are a systemically important institution. If they fail, the financial system fails. So the government protects them. Now let's connect this to the margin hikes. The CME raised margins twice in 1 week. Why? They claim it is because of volatility. When the price of silver moves too fast, the exchange needs more collateral to cover potential losses. This sounds reasonable, but the timing is suspicious. The margin hikes happened right as silver was breaking out, right as the China export ban went into effect, right as the Tokyo premium was spiking. It is almost as if the exchange wanted to stop the rally. By raising margins, they force leveraged traders to liquidate. This creates selling pressure. This caps the price. Who benefits from a capped price? The banks that are short. The banks that owe silver they do not have. If the price goes to 150, those banks are insolvent. So the exchange steps in and pulls the emergency brake. They crash the market to save the shorts. This is why silver dropped from 79 to 69 in 24 hours after the second margin hike. It was not a natural sell-off. It was a forced liquidation. The exchange engineered a flush to protect the system. But the physical market did not crash. The premiums in Asia did not crash. Only the paper price crashed. This is the fracture. Here is what the 3 million ounce delivery tells us. The banks are no longer trading silver for profit. They are trading silver for survival. JP Morgan forced Deutsche to deliver because they need the metal. They cannot source it from China anymore. They cannot source it from the retail market because premiums are insane. So they are cannibalizing each other. This is a sign that the physical float is nearly gone. The float is the amount of silver available for delivery at any given time. For decades, the float was huge because nobody took delivery. Traders just rolled their contracts. But now, industrial buyers are standing for delivery. ETF holders are redeeming for metal. Sovereign funds are pulling bars out of London. The float is shrinking. And when the float hits zero, the paper market breaks. The COMEX will declare force majeure. They will settle contracts in cash instead of metal. And the price discovery will move to the street. The real price of silver will be whatever someone is willing to pay for a physical bar, not what the screen says. This brings us to the ultimate question. If JP Morgan is hoarding silver, if they just seized 3 million ounces from a rival bank, what are they preparing for? Are they preparing to cover their short positions? Are they preparing for a systemic default? Or are they preparing to control the reset? Let's game this out. Scenario 1, the squeeze. If the physical supply runs out and the price goes vertical, JP Morgan will be the last bank standing with inventory. They will be able to name their price. They could sell silver at 200, 500, or 1,000 per ounce to desperate industrial buyers. This would generate obscene profits, but it would also expose the lie of the paper market. It would prove that the COMEX price was fake. It would destroy trust in the futures market. Scenario 2, the bailout. If the other banks default, JP Morgan could step in and buy their positions at a discount. They become the consolidator. They absorb the market share. They become the monopoly. This is how power is concentrated during a crisis. Scenario 3, the reset. The system realizes that the paper market cannot continue. The regulators step in. They freeze trading. They revalue silver at a higher price. And they settle all contracts at the new official price. JP Morgan, because they hold the most physical, becomes the anchor of the new system. They are not just surviving the reset. They are designing it. So what does this mean for you? If you are holding physical silver, you are holding the asset that two of the most powerful banks in the world just went to war over. You are holding the metal that is trading at 130 in Tokyo while the screen says 72. You are holding the supply that no longer exists in the vaults. The banks know this. The regulators know this. The insiders know this. The only people who do not know this are the ones still staring at the COMEX price thinking it is real. The 3 million ounce delivery is not just a data point. It is a signal. It is a message. It is the banks telling each other, the game is over. Deliver or die. Deutsche delivered. JP Morgan collected. And the rest of the market is pretending everything is fine. But here's the twist. JP Morgan is not invincible. They are playing a dangerous game. By squeezing other banks, they are creating enemies. By hoarding supply, they are creating resentment. If the other banks unite, if they demand an audit of JP Morgan's vaults, if they call for regulatory intervention, JP Morgan could be exposed. What if they do not actually have the metal they claim to have? What if the SLV ETF is fractionally reserved? What if they sold the same ounce to multiple clients? This is the risk of concentration. When one player controls too much, they become the systemic risk. If JP Morgan fails, the entire silver market collapses. And the regulators know this. So they are stuck. They cannot shut down JP Morgan. They cannot let them fail. But they also cannot let them rig the market forever. We are in a Mexican standoff. The banks are holding guns to each other's heads. The regulators are holding guns to the banks. And the physical silver holders are sitting outside the room, watching the whole system eat itself. The 3 million ounce panic is just the beginning. This is not the end of the bank war. This is the opening salvo. We are going to see more forced deliveries. We are going to see more margin hikes. We are going to see more price dislocations between New York and Tokyo. And we are going to see the paper market lose credibility. The infinite money glitch that JP Morgan has been running for decades is failing. The code is breaking. The system is resetting. And the only thing that will matter when the dust settles is who holds the metal. Deutsche Bank just learned that lesson the hard way. They thought they could short silver and roll the position forever. They thought the supply would always be there. They were wrong. JP Morgan forced them to deliver 3 million ounces. And now Deutsche is out of the game. How many other banks are in the same trap? How many other institutions are short silver they cannot deliver? We are about to find out. Because the China export ban just removed 100 million ounces from the market. Because the industrial demand is not slowing down. Because the vaults are not refilling. The banks are fighting over a shrinking pile of metal. And when the pile runs out, the paper market dies. This is not a conspiracy theory. This is math. You cannot deliver what you do not have. And the banks do not have it. So here is my final breakdown. The 3 million ounce delivery from Deutsche to JP Morgan is the most important silver story of 2026 so far. It proves that the banks are in survival mode. It proves that the physical market is detaching from the paper market. It proves that the price you see on the screen is not the price you pay in reality. And it proves that the insiders are preparing for a reset. If you are holding physical silver, do not let the COMEX price shake you out. Do not sell because the chart looks weak. The chart is a lie. The real price is being discovered in Tokyo, in Shanghai, in the vaults where the metal actually exists. And that price is triple digits. The banks know it. The governments know it. The industrial buyers know it. And now you know it. The 3 million ounce panic is not the end. It is the signal that the endgame has begun. The paper market is dying. The physical market is taking over, and the greatest wealth transfer in history is unfolding in real time. The only question is, are you holding paper or are you holding metal? Because when the system resets, only one of those will matter. Subscribe.